And the market did sell off as expected. So, it's one of those things where, lots of times you're looking for a reason to get short, and it doesn't always work. And when it does work, that's why you have to have the confidence to stick with your way of trading. When the market's volatile, sometimes you're going to get chopped around a bit, but, if you stick with it, you can profit. And, we're coming into the 2 o'clock time, which is the old pit closing, and we're starting to go sideways. Then sideways and start selling off, but nothing really in there to really tell me to get short some more. Already we're after 2 o'clock, and, you see the volumes is dried up considerably. We come in here at just before 2:30, you have a selling imbalance, okay? And, if you just go back the chart before, we came up to our high here at 169.00, down to 17, 18, and all of a sudden you have this, imbalance as, we're sort of going sideways. But there's a couple of ratios here. I don't know. I said it's 2:30. It's not necessarily a time I'm looking to trade. In this case, the market, it did sell off. I don't want to claim it as, as a victory or anything, but it's going into the close for the day. It's already 2:30, and most traders have already closed their books for the day. But the market, it did give you a chance to get short around the 24 level. It did come down nicely into the, 14 area, and even continue lower down to, almost 00. It's 168.02. But, so that's the end of day 3 in the bonds. The last charts I want to go through, it's 1 day in 15-minute charts in the ES, the E-minis. Now, when you're dealing with longer term charts like 15 minutes, it's hard to get everything on one chart. You got to scrunch it a bit. So, to make it easier, I'm just going to show you some of the edges of the bars and just sort of talk you through some of the setups. So this is 8:45. This is on March 9th. This is a 15-minute chart. And what do you have? This is the bar where the cash opened, 8:30. 8:45, you have a buying imbalance, a small print ratio and a divergence. And you get this huge, massive bar. Okay, but it's telling you get long. Where are you going to get long? I don't know. You're going to look at the point of control. This is the top end of the bar that you saw earlier. Or sorry, it's not even. This is 8:45. The bar closed up here. This is 9 o'clock already, so it traded higher. Ideally I'd like to be getting long at the point of control, which is here, but the market never came down there to give you a chance to get long. And in 15 minutes, you're covering a lot of area. So, that's why I don't necessarily like such long-term charts. But, they do give you the same, you're looking at the same things, the same sort of signals that you want to trade off of. And so we hit the high. There's no ratio up here, and the market starts coming down lower and lower. Gradually going lower. And what do you get? It's coming off. You get a selling imbalance here. And the market rallies right back up into it. And, it doesn't, it just goes and stops you out. Okay, which is fine. But, I mean, it's one of those where you take it into context. Look where the market has sold off. It's sold off from 1857 down to 1837. It's a 20-point move. Then you get a selling imbalance. Do you want to take it there? No, I don't want to take it there. And if you did, it was never worked out. Just went against you pretty quick. You already had that move lower. I'd rather get the selling imbalance much higher. Okay, so I said, take things in context. Just because you have a selling imbalance, don't get all excited and look to take it. Take it, in areas where you think you can make profits. Not after a 20-point sell-off. Look to get short. You want to get short, before the 20-point sell-off, as early into it as possible. And then the market rallies back up. And, we come up, back up towards the high. Again, there's nothing in these ratios right now telling you to get short. Then what do you see here? You see a buying imbalance, in a red candle. It's not the greatest signal. In this case, the body of this red candle is very small. It's one tick. So I mean, then you run into this doji candle. But, what's important is you stay below it. I don't know if it's hard to say try and get 2 points out of this because, these bars are 10 points. So, I mean, it's take things into context, but, you're still looking to trade from the short side, ideally you'd like to see some sort of signal to get short, but there's just nothing in there. And then what happens? The market comes off. You see this nice down bar. Nothing in the ratio here, and the market starts ticking back up. And, again, nothing in the ratios. It said you don't always get things in the ratios, but when you do, try and pay attention to it. Now here you have a small print, but again, it's just behind this green candle, which, I don't really like. And then the market sort of rallies back up through it. Again, you get the same thing happening here. Here you have a ratio, but it's, it's a buy, it's a bullish ratio, so it's telling you possibly get long, but you already, had a move up. But you see, this is one of the problems with trading with bars, time bars, is because, it's based on time, so you're going to get candles that, some are extremely long, some are extremely short. It just depends on what's trading. But then we hit the high, on a bar with a bullish signal, a ratio, a bullish ratio. And then you're met with a red bar, just after it, which, is generally more bullish. But then again, it's one of those bars where, price is trading by time. It's not trading by, the market's trading by time, not necessarily by rotating around price. It says, 2 o'clock start a new bar, 2:15 start a new bar, 2:30 start a new bar. That's why, for me, I find the ratios, while they're still important, sometimes, they just don't make sense because of the way the bars are formed. It's not like buying or selling is necessarily drying up as price moves from one price, as the market moves from one price to another. It's just, it changes all of a sudden. But if you're getting them on edges at highs and lows, or swing highs and swing lows, it's still important just because, not just because, but just like you saw here, right after the open, you have the divergence, you have the ratio right on the low, look to get long. Going back over, the rest of the day, there wasn't any other ratio, appearing at the edge of a bar in a direction that you want to go in. Back here, yeah, you did have this one buying imbalance, but then again, it's sort of already in a down move. It's not on a high, which is what you want to see it on. You want to see this bar, not being in the middle of a move lower. You want to see it, towards the end of a move up, not on a move down. Nothing on these ratios down here. These are just average numbers. And as you start to move up again, nothing. Here it's appearing after this candle, but it's, I said it's, this candle is engulfed by this previous candle. That's one of the functions of when you're trading on time-based charts is the chart, the bar. It's, it's formed by time, not by movements in price necessarily. But, I want to see how they trade around the highs or the lows, the edges of the candle, or the edges of moves. When the price hits a high, and then you get a ratio, it's important, and it's hard to sometimes see that on time-based charts. So there was probably one possible trade of the day, and it was just in the morning, and, the market went from the low straight up to the high. So finally, that's the end of lesson 19. It's a long lesson. I had to break it up because I ran into recording limits. Yeah, in the next chapter, we'll just conclude the course and we'll move on. So thank you very much.